A mortgage is really just a loan on your house, right? So you're going to go and say, hey, I'm buying this $1 million house. Because it's a $1 million house, it's a jumbo loan. For most people, you're going to need to put 20% down. I need a mortgage for $800,000. When you pick the mortgage type, you decide how quickly do you want to pay this off. And there's typically different interest rates that come with different loan types. Let's say that you want a 30-year mortgage. It's going to be a 7% interest rate. That's going to be fixed for the whole 30-year period of time if you don't refinance. Then you have a 15-year. 15-year typically comes with a little bit lower of an interest rate. I see it anywhere from typically like 0.3 to 0.75. So let's split the middle and say 0.5% lower. Now you're going to get a 15-year mortgage for that $800,000. It's going to be at 6.5% the whole 15 years unless you refinance. Then there's two other types. One is interest only. So interest only says it works exactly how it sounds. All you are going to do is pay the interest of that loan. I don't see these very often because you're almost like renting the home and you're kind of just hoping that the appreciation is good enough to recoup that. If you have interest only and it goes down, you can put yourself in a very serious position because you're not really building any equity. Sometimes people do this if they're only going to live there for a few years because you're mostly paying interest anyways and it gives you a little bit more flexibility. The last one is ARMs. ARMs are really just adjustable rate mortgages. So typically they come at 3 years, 5 years, or 7 years. They give you a rate that's typically lower. Instead of 7%, they're going to give you a 6.3% adjustable rate mortgage. So you basically have this loan for that 3, 5, or 7 year period of time. It stays the same. And then at the end, it basically readjusts and you have to look at what market prices are. Rates are high. People say, great, I'll take out the ARM. My assumption is that rates are going to be lower at X period of time. And that way I can refinance into that lower rate. When they're low, right, 3, 4% in the 2020 period of time, ARMs didn't make a whole lot of sense because you had such a low historic rate that you're saying, I only want this for a short period of time. And I think it's going to be lower in the future. But for some reason, I still saw a lot of people do it because it came at a lower rate. So they said, hey, I'll take the 0.3 or 0.4%. So I'll go from 3 to 2.6 to get this ARM. But the issue is now they were thinking just short-term savings. They're not realizing when this ends in this year, next year, the following year, they might be moving to 6 or 7% and they're going to pay significantly more than if they would have done the fixed loan. I like ARMs today because typically when you put 20% down, you're going to get a lower rate. And rates are pretty high right now, right? So ARMs are kind of this ability to say, hey, I plan to refinance in 3, 5, 7, or whatever years. I will grab this slightly lower discounted rate and I'm going to get a new loan in that period of time. Because it's a high interest rate environment, I don't dislike them today. But when we're thinking about fixed loans between 15 and 30 year, I like 30. The downsides of a 30 year are 1, it's going to have the higher interest rate. 2, you're going to pay more interest because it's over 30 years versus over 15 years. But the good about it is 1, the payment is lower. So that gives you more flexibility. I've seen and I've worked with people who they want to start a business or they want to go take a different job, but they can't because the income is going to be lower and they wouldn't be able to afford their mortgage because they have a 15-year mortgage. So it gives you flexibility, but it also gives you the ability to pay it off in 15 years if you want to. So if you said, hey, I know the payment to get me to 15 years, I'm going to do it. But now if something happens, I can then change and reduce down to that 30-year rate. I really like that. There's a lot of people who say, well, just do the 15-year mortgage. And if you need to refinance in the future, you can. And I know people who did that in 2018, 2019, 2020, right? And now they have these 3% 15-year mortgages that they would like to reduce the payment, but they can't. If they refinance to 30 years at 7%, the payment's the same. It might even be more. The issue is a 30-year mortgage, because it's stretched out longer, can push people to buy too much house. Typically, right, you're not going to be able to afford as much house. And in today's environment, it is very hard to afford a 15-year mortgage. Let's go through just a couple examples. So let's start with $1 million mortgage where you put $200,000 down, 20%, and you get the 7% interest rate. And again, this is a 30-year mortgage. What that would look like is a $5,322 monthly payment per year, right? $64,000 and some change that you pay just for principal and interest. And if you look over a year period of time, in that first year, you're going to only end up paying down about $7,400 of principal and the other $51,000 of interest. And so what most people don't understand is mortgages are really front loaded, which makes sense, right? Because the balance is so high, you have so much in interest. 7,400 goes to the principal. So then the next year, you don't have an $800,000 loan right now. You have a $793,000 loan. Your payment is still the same, but because now we have less of the loan, more of that monthly payment goes to the loan than before. And every year it keeps getting bigger and bigger and bigger. And over time, you eventually start to make a lot of progress. But if you look at this, right, after the first 10 years, you have only really built 112,000 of equity, even though you pay more than that in just 2 years of payments. This is why when you buy a house, it typically makes sense to only buy if you're going to be there for a long period of time, because it takes a lot of time to actually pay down the principal. So let's go to a 15-year loan. So we're going to do the exact same loan, $1 million, house, 200,000 down, $800,000 mortgage, but this one's gonna be at 15 years, so we're gonna get 6.5% interest rate. With that loan, your monthly payment now is $69.68. But if you just compare the two, on the 30-year mortgage over that period of time, you would pay about $1.1 million in interest, and on this 15-year one, you'd only pay $454,000 in interest. This is where people say, well, shoot, why would you not pick the 15-year loan if with the 15-year loan, you're gonna end up paying so much less in interest? And if you view it in a silo, that totally makes sense. But we can't view it in a silo because you still have that $1,600 a month difference. If you're somebody that would say, hey, great, I got $1,600 extra a month, I'm going to go get that invested. That's what's going to help me max out my Roth 401k or traditional 401k, or do my Roth IRA, or invest in a taxable account. Well, then that might be better. You're really banking on what is that appreciation you'd get over that period of time, right? You're getting investments front loaded. And so you might end up in a better situation, but it's unknown. When you pay down the loan, right, you have a known rate that you are paying down. So you know what you're saving by doing it, where with investments, you don't. Now let's talk about paying off your house quicker or not. My belief is that I don't want to pay off my mortgage quicker, right? I know I have a 7% interest rate. That's pretty high. I'm paying a lot of interest, but the reason why I don't want to pay it off quicker is every year it's getting cheaper, right? My mortgage payment is staying the same. So if right now I spend $5,000 a month on my house and mortgage, et cetera, 10 years from now, if I still spend $5,000, that is significantly cheaper. And then another 10 years from now, and another 10 years from now. The other reason is that it doesn't give me a lot of flexibility, right? If I go invest those extra dollars and I put that in a taxable account, that is accessible. I can use it whenever I want. It's not subject to interest rates unless I want to borrow against it, etc. But for people who do like to pay off their mortgage, I typically recommend that they don't actually do this monthly. That what they do instead is that they save these dollars. So let's say you said, hey, I got $5,000 a month of surplus. I want to save $1,000 a month for my house. What I have them do is I have it save into a savings account. I'm going to let that grow. And then every few years, I'm going to go dump all of that down. So let's say we waited 4 years, we have $48,000. I'm going to go pay $48,000 to my mortgage. And as long as I qualify, I'm going to ask my company to recast my mortgage. Recasting the mortgage, all it says is, hey, you have way lower of a balance. I want to keep the same loan, but I want the monthly payment to go down, so I pay it off at the same end period of time. When you typically pay extra towards your loan on a monthly basis, it doesn't change your monthly payment. It just gets the balance down. So it's not helping you in a way of freeing up cash flow and giving you the choice on what you want to do, where recasting does give you that option. So even if you did do $1,000 a month, every few years you might want to reach out. They're going to recast the mortgage and lower your payment, and you can still pay them more if you want to, but it does give you more cash flow, more flexibility, lower expenses, etc. The next one is refinancing. So when does refinancing make sense? There's those people out there who refinance anytime they can, right? They had a 7.5% loan, it went down to 7, and they refinanced. From 7, it was 6.8, they refinanced. This is typically not what you want to do for a few reasons. One of them is closing costs, right? Every time you refinance, you have closing costs. The closing costs get rolled in, so it adds to your balance, and you restart the 30-year amortization. You want to refinance only when it makes sense and where you think that's the right refinance, where it's going to be for a while. So instead of 7.5 to 7, maybe now it's at 6.5 and you're like, oh, I don't see rates going lower. I got to take advantage of this. You grab it and then you wait a few years. And if there's another really compelling rate drop, where the monthly savings is good, you do it. But there's one other variable you need to think about here, and that other variable is payoff time. So let's say you refinance, the cost to refinance is $5,000 and it's going to save you $100 a month. Well, that means it would take you 50 months to recoup the $5,000 of closing costs. So if you were saying, hey, I'm going to move in 2 years, the refinance doesn't make any sense because you're not going to recoup those dollars. On the flip side, if the refinance was $5,000 and it was going to save you $500 a month and you're going to live there for 3 years, that's only a 10-month period of time to break even. Obviously, you don't know for sure when you're going to move, but you want to take your best guess here. And if it's like, hey, it's going to take 2 years to break even and this is your forever home, great, that makes sense. If it's going to take 2 years to break even and you're planning to move next year, that probably doesn't make sense because you're going to end up in a worse situation than just that monthly cash flow is going to benefit you. The last one is home equity lines of credit. Home equity line of credit is really borrowing against your house. Let's use this example of $1 million house, $500,000 of equity in it. Typically, you can borrow from that equity as long as you leave 20 to 25% equity in the home. So you need to leave 200,000 or 250,000 of equity. The rest above that you can borrow, and it's typically at variable rates. Some places you can get a fixed rate. I like home equity lines of credit for a few reasons. One of them is I like having them as a backup emergency fund. So you have it open. If you ever need it, you can borrow against it. But I don't like you using it for random spending or things that don't make sense. If you're like, hey, I'm going to do a home project and I know over the next couple of years, I'm going to have RSUs hit or bonuses or something where I can do it and I want to get the project done today, it might make sense to borrow from your home equity with a home equity line of credit. And because you're improving your house, that amount becomes deductible. So it benefits you in a couple ways. And I just like it as a, oh my gosh, we're in a tough situation. Do we want to sell investments? Do we want to sell X, Y, and Z? Or do we want to borrow against our house? This all comes down to risk tolerance, but they are good tools. And I like to have all of the right tools built up before we actually even need them. Home equity lines of credit are great, but oftentimes I'll see people say like, hey, I have 200,000 of equity in this $1 million home. I need to pay off other debt. I'm going to go borrow from my home equity line of credit. Well, you don't have enough equity. There's nothing to borrow from because you don't have that equity. So if you just recently bought a home, the home hasn't appreciated a ton, you haven't paid down the loan, you're not going to have equity to borrow from. But if you are somebody that maybe bought a house in pre-2022, you probably have a low interest rate and you probably have a lot of equity in your home that you could borrow against. And so a lot of people right now are like, hey, I need to improve my house. I need to make my house bigger. I don't want to move because I have this 3% mortgage rate. What makes sense sometimes is borrow against your home, use the home equity line of credit, build out that current home to be a little bit bigger or to fit the needs that you have versus have to save for 5 to 10 years to get there, right? You're still going to pay the interest, but it's going to be better than going to a whole brand new house at that new higher interest rate. That is everything that I wanted to go through today. Hopefully this helped you better understand why I like 30-year mortgages the best, the different options that you have, when to refinance, why recasting is beneficial, why I like HELOCs, and when they can make sense for you in your financial life. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.